Let's finish chapter 13. Let's take a look at SWOT analysis. You've seen this in other classes, undoubtedly by now. SWOT analysis. This is a tool to assess company strategy. SWOT is an acronym, and we'll start with assessing the strengths of a company. These are things that give a firm a comparative advantage. Examples of strengths include customer service, quality products, brand image, research and development, finances. These are things that you look for in a company that give a company a comparative advantage. Weaknesses, okay, what are some things that competitors could exploit? And so look at all these things that we just mentioned up here, and you ask yourself, is the company vulnerable to competition in any of these areas? And we can all think of companies that do these things well and that do not do these things well, okay? Opportunities. These are factors that favor the firm, such as market growth. These are natural things that favor a firm. Market growth, so choosing the right market to be in. Industry structure, what are the competitors, how intense is that competition? Exchange rates, are these things that create opportunities, or are these things that detract from opportunities? Threats, these are things that can hinder the firm. Substitute products or technology, sluggish markets. What are some things that you have to look out for as you're considering investing in a firm? All right, management has to gather data from various sources from within the firm and outside the firm to evaluate their company, their industry, their economic environment, to devise appropriate strategies, to communicate these strategies, and to execute. This is what management does. When you're running a company, you have to gather data, you have to determine what your competitive position is, determine where you think the marketplace is going, and you have to be ready to be early out of the gate with products and services, and you have to excel in certain areas in order to defend your company's position. Because industry conditions vary over time, companies have to change strategies often to meet these conditions, all right? And so when you're buying into a company, you're buying into management. Take a look at the management biographies. See if these are people who have experience, have a track record of success, okay? All right. Here's some lessons from Peter Lynch, and you might be asking yourself, who is Peter Lynch? I recommend that you look up Peter Lynch. He's written a few books. He was an investment manager in the 1980s and 1990s with Fidelity. Fidelity was a very small company until Peter Lynch got there. Peter Lynch may be the greatest stock picker in the second half of the 20th century. And here's what he looked for in companies and their stocks. First, avoid companies that have faddish products that won't last for a long time, all right? Avoid high-style retailers and food companies. He did not like TCBY, okay? He probably didn't like tofu. So you avoid those things that get hot, but that you know they won't last long. How about those spinner things that were so hot for a year or two? Where are they now? They've completely disappeared. Hopefully, you didn't invest in any of those companies. All right, look for companies that have repeat business, like dry cleaning and razor blades. Well, wait a minute. Dry cleaning was a really good business up until about 10 to 15 years ago, and really two things have happened with dry cleaning. Dry cleaning used to be a repeat business. People would take their laundry every week, and there was a high volume of business being done. But here's what happened to the dry cleaning business. Two things. First, people are less formal. People wear less formal clothing today than they used to. And two, the fabrics have changed, okay? And so people used to wear dressier clothes, and these dressier clothes were made of fabrics that needed to be dry cleaned, specifically wool, okay? Now people don't wear dressy clothes as much, and a lot of the fabrics can be thrown into the washer and dryer at home, And so dry cleaning is not the lucrative business that it used to be. No Shave November is something that is not good for the razor blade companies. And there's a lot more competition in the razor blade business than there used to be, all right? Look for companies that have a competitive advantage, like Microsoft's operating system. Do you really want to compete against Microsoft? There are only 1 or 2 companies out there that can compete against Microsoft. And you might say Apple is an effective competitor. Not in the PC business, they're not. Not in the PC business. Okay? Look for a minimal threat of technological change, or of substitute products. Look for companies that have really rock solid products. Now, how do you know when a change is happening? You really don't know. When something out of left field might happen that might completely change the competitive position of a company. All right? Look for companies that can reduce their costs. They often do this through automation. Okay? Can companies reduce the cost of doing business? And that's what technology is all about. Okay? Look for companies that have a very strong business story and that they can survive a poor CEO. What Peter Lynch said was, look for a company that can survive a poor CEO, because at some point they're probably going to have a poor CEO. All right. Lastly, look for a company where management is buying shares. You want management to believe in the company. You want management to own a large position in the company. All right. So let's look at a different way of classifying or categorizing companies and their stocks that you might look to invest in. First, we have slow growers. This is a mature industry. Okay, sales growth is going to be slow. Look for new products, new markets, new distribution. Okay, then we have the stalwarts. These companies still have above average growth. I would say that Walmart is a stalwart. I would say that Amazon is becoming a stalwart. In the next few years, Amazon is going to be so large that the growth will slow and it will become a stalwart. Above average growth, but there won't be many surprises anymore, okay, from these companies. And in this group, you're going to look for cheaper PEs. All right, fast growers. These could be risky if the PE assumes growth will continue. Be careful what you pay for these fast growers. Again, if you're a growth investor, you're not looking too closely at PEs or multiples. All right. Well, we've got a little problem here with our animation, but we're going to live with it because we're going to finish this chapter. We only have one more slide after this. So the cyclicals, the prospects are tied to the growth rate of the overall economy. So these are mature industries. These are the slow growers, and they're mature industries. And there are times, this is where you have to be really nimble. When the economy is accelerating, you want to be in these stocks. When the economy is starting to decelerate or top out, you want to steer clear. Turnarounds. These are companies that have had serious problems, and the question is, can management correct the problems? All right. Asset plays. These are companies that have some valuable assets. For example, Dillard's has not been a great operating company, but Dillard's owns a ton of real estate. And the question is, does Dillard's stock price capture the value of the real estate that could be sold if Dillard's wanted to sell some of their real estate? Okay? So land, trademarks, patents, customer bases, these are all sources of assets. All right, last slide. How do we gather information on companies? Well, we can review published research. If you open an account at any of the brokerage firms, including the discount brokerage firms, you will have access to published research. Okay? You can buy research without opening up a brokerage account. Research like Value Line or Standard & Poor's. You can read magazine articles, newspaper articles, go to the internet, Google. Okay? Review company material. Go to company websites, okay? Look at their annual reports, look at their 10Ks, look at their 10Qs, a lot of information out there, okay? You can do interviews. If you're a good customer, you can call an analyst. You can call a company management team. Every publicly traded company has an investor relations department. You can find that information and you can call the investor relations department and talk to them, okay? If you, maybe you could even get the chief financial officer on the line, possibly, but probably not. You probably end up talking to investor relations. You can also talk to customers and with suppliers of companies. That's called supply chain interviewing, and you can go into the supply chain, and that's something that analysts do a lot of, is they interview large customers and they talk to suppliers to see what the demand, what the pace of business seems to be like at the company that they're doing business with, okay? When you're talking to someone, watch out for their motives. When someone tells you something about a company, you have to consider what is their motive. Are they trying to pump up the stock, okay, or are they trying to make you believe that the stock is not, and the company is not doing well? I remember several years ago, a person that I was working with got involved in chat rooms, and he got in trouble for spreading false information about a stock. He was short a stock, and he spread false information about the stock, and the stock fell, and then the SEC investigated and found that he had been in several chat rooms telling untrue things, and he got in trouble for it. So watch out for what people say, particularly when people go on television and they're asked about companies. They have to disclose now whether they're long or short the stock. So that's a good thing to know if someone has a motive, a reason for saying the things they're saying. Okay, so we're finished with chapter 13, kind of a general chapter, and we'll move on. Peace out. See you in chapter 14.